Trump's ascent into the White House as the 47th president has shook markets. Stocks are at all-time highs. Bitcoin at all-time highs. Precious metals are falling, though. So what's next? We'll talk about commodities, the outlook for the economy, and what's next for markets with Gary Wagner, editor of thegoldforecast.com. Welcome back, Gary. I know it's only been less than 2 weeks since we had you on the show, October 31st, but I thought I'd get you on for an emergency update on gold. After Trump won, the price of gold fell. I think this is the first time we spoke actually in many, many months when gold is not at a new all-time high. Have you shifted your market outlook at all? Not just for gold, but the economy overall. Have you shifted the way you look at the economy and markets after Trump's win?
Well, certainly the fact that Trump won is a decisive factor in what we're seeing in U.S. equities. Those have moved higher. Cryptocurrencies out of control to the upside because he is an advocate, and gold, oddly enough, moving lower. My best explanation for why we've seen gold drop $200 from the all-time record high at $2,802 down to current pricing at around $2,600 is the last leg of the upside move rally in gold that took gold from about 2640, 27 up to the all-time record high was largely based on the uncertainty of the outcome of a presidential election, and most importantly, whether or not we would get a decisive victor, meaning an uncontested result. Had the other candidate won and Trump chose to say that that was unfair or something, that would have really fueled gold to higher pricing. But the fact that Trump won, there was certainty in that. There was a peaceful transfer of power. The uncertainty factor that was baked into the price of gold diminished, came out, and that's why we've seen gold correct by $200.
Could you also explain gold's decline by the movement of the DXY, the dollar, which surged the night of Trump's election win?
Well, that one's a little bit harder to explain, but prior to the election, we had both the dollar and gold moving higher.
Yes.
Once Trump got elected, the dollar continued to gain strength, but we had the standard correlation between the dollar and gold reemerge, in which dollar strength really hindered gold moving higher. In fact, gold was unable, as it had prior to the election, because of that uncertainty factor, was unable and has been unable to overcome dollar strength. It's a very rare occurrence when you see the dollar and gold moving higher in tandem at the same time. And we've seen the standard correlation move back into the market, in which dollar strength is definitely putting a bearish headwinds to gold.
A couple of weeks ago when you were on the show, people can check out our last interview, by the way, October 31st, we had a lengthy conversation about the geopolitical impacts on gold. In other words, how geopolitical tensions impact the price of gold. Do you think gold's fall from its highs after Trump's win may have been due to the fact that the market sniffed out potentially, I'm not saying it will, but potentially more political stability because Trump wants to end wars. He's made that promise on campaign trails. He wants to end the Ukraine war on day one. He said he'll do it on day one. He wants Israel to end the Hamas war by the time he gets into office. Those things mean, less uncertainty. What do you think?
Well, first of all, absolutely. If Trump can match his actions and outcome of those words with a result, meaning even draw these two conflicts, Ukraine, Russia, and the Middle East, closer to a resolution, then the geopolitical conflict premium, let's call it, will diminish. He's talked about the fact that by the time he gets in office, he will have resolved the war in Ukraine. He will have come to some sort of a peace agreement over in the Middle East. If he can pull that off, and that would be a great feat, but if he can come closer to diminishing the terrible conflicts that are going on, then that would continue to pressure gold, because I believe currently there is still a premium in regards to the geopolitical conflicts that are ongoing. If he can resolve those would create pressure on gold. That's the thing that we'll have to wait and see as we get closer to January when he takes office, and has he actually accomplished what he said he could do.
What about interest rates? The 10-year yield has also spiked in the last week. Well, it's been going up even before the election. The 10-year break-even inflation rate has been going up, signaling higher inflation expectations. But should the 10-year yield rise, should interest rates continue to rise, would that put pressure on gold as well, you think?
That correlation remains soundly footed within gold pricing. The question that I have to pose without having a direct answer is that what we need to see is the action of the Federal Reserve. Now, they have cut rates, a jumbo rate cut a little while ago, a 0.25% rate cut in November. It is anticipated that the Fed will cut by another 0.25% at the December FOMC meeting. And most importantly, what they are focused on in terms of their dual mandate is to right now normalize interest rates. In other words, take them between 3% and 3.5%. So there's a ways to go. If they continue to cut rates, that's going to be bullish for gold. If rates are maintained at the current level, if they pause, that would change the dynamics to what I believe is going to happen, which is that the Federal Reserve will continue to cut interest rates as they normalize them to between 3% and 3.5%.
Let's flip over to some charts now, Gary. I think the ultimate question, and where I'm getting at with all these questions, is the run in gold over?
Okay, let's try to answer that as best we can, and I'll go ahead and I'll pull up a chart. What we are looking at is a daily standard candlestick chart of gold, and on that I'm using Elliott wave along with Fibonacci retracements and one moving average in blue. That is the exponential moving average. It is my current belief that what's called the impulse cycle in Elliott wave terminology, meaning waves 1, 2, 3, 4, and 5, ending at 2802, completed that impulse phase. And I also believe that we are in a corrective phase. A corrective phase is part of the 8-wave cycle, 1 through 5 being the impulse and an ABC being the 6th, 7th, and 8th wave. I believe that we have probably completed the A wave. In other words, the $200 move from 2,800 down to 2,600, I believe is most likely over, and we will enter what is called a counter wave or a B wave. Now, the counter wave or a B wave, and I'm going to make that a little bit clearer, is a point in time where we'll see gold rise anywhere between 50%, 2688, and 75%, 2740 to round down as the next rally. So I think that short term, we are going to see gold return to rally mode, but not take out 2,800. However, I am labeling one of our models is called a running flat correction, which anticipates the final corrective wave, the C wave, to actually be above the A wave. Typically, it's below. The reason I believe that there's a high probability of that is because of the fundamentals at play that have moved gold dramatically higher. If that's the case, in Elliott wave theory, once you complete the full 8-wave cycle, 1 through 5, A, B, C, if the fundamentals that drove the market to have what we call a bull count remain, in other words, if the fundamentals remain, then we will start that clock all over again, doing A wave 1, 2, 3, 4, 5, and that would be next year. And if that's the case, it would take out 2,800 and go to a new all-time record high. But before we get to that, we have to complete this corrective phase if Elliott Wave has any true merit and is accurate in being able to predict pricing. It's worked well for me. The models that we created, I anticipated 2800. I actually looked for it to be an extended fifth wave, which it turned out not to do, which was my upper level call of 2865. But it did run to 28, and I do believe that that completed the 1 through 5, and that we've gone through really the worst of the correction, meaning a $200 price drop in gold from 2800 to 2600. Right now, I would look for gold to find support here or maybe a little bit lower, but not too much lower. I don't see it going much below 2600. And as I said, I would look for that counter wave to take gold back up to 2700 or 2740. One more small correction, and all things being equal, my belief is we will restart the bull count or bullish cycle will run again. If you recall back in 2011 when gold ran virtually from, depending on where you go back to, 700 or 1,000 to 1,900, it went through either 2 or 3, I believe it was 2 full bull counts. In other words, 1 through 5 ABC, 1 through 5 ABC. So it ran through it twice. There's no reason to assume that gold will not return to a full bullish count after this correction is over.
Gold has seen declines before of a larger magnitude, as you've pointed out in the past. In 2011, gold peaked. 2012 saw gold drop by 40-50% over the course of the next couple of quarters after its peak. But that happened over several months. Now, the magnitude and the speed at which gold dropped from its last week's high, does that surprise you? The speed at which it happened?
Is it surprising? If we look at, and I'll see if I can do that, but if we look at, for example, gold on a weekly basis, and I would have to find a chart that does not include, there we go, weekly. If we look at gold in terms of a weekly chart, we had a near parabolic move up. This is a weekly candlestick chart, and you can see that at least since September, it was almost, I wouldn't say it's absolutely not at 90%, but it's about 85 or 70% tacked on the way up. Typically, when you get something close to parabolic up, you typically will get a very strong or hard correction down. So in that way, it does not really surprise me.
When gold moves really fast, up or down, in the past when it happens, does it usually mean more momentum in the same direction or reversal? In other words, if gold moves really, really quickly down, does that usually imply more downside? I mean, gold has moved really, really quickly up this year several times, and that has been followed by more upside this year.
The key is technicals are only as good as the fundamental fabric that's in play at the moment. And if we look at the long-term move in gold, the real bottom occurred at about $1,960 back in October of last year, and it moved from 1,900 to 28, a $900 move. That's a superior move. I mean, that's the same kind of move we saw in 2011. However, in 2011, we actually had a long procrastinated price decline. In fact, for the first year after it hit 1900, it oscillated between 1900 and 1800. And then when it broke, I believe it was 1564 in the charts, it virtually crashed over a multi-year period down to just above 1,000, 1,020. I think in the case of current pricing, we have more than just a economic recession or a banking crisis or Federal Reserve intervention, because the geopolitics and the conflicts were not as intense. So we are working with more variables that have propelled gold higher that I believe will continue to move gold higher from this point after the correction has concluded.
Now, we've talked about your outlook for the rest of the year for gold. People, again, can watch our last interview from just a few weeks ago. Have you changed the upside target for gold by the year end following last week's events, Gary? I think you were projecting yeah, I'll let you revisit for us the upper band of your forecast.
I believe that the highs that came in at the end of October at $2,800 were in fact the peak. It's the highest value on record. I believe that that will not be taken out this year. We only have 2 more months left, but more likely next year. I think that in terms of my forecasts, I had to update them a couple of times because at first I was looking at about 2,700, and as more fundamental variables came in, we had to modify our model to really fit the fundamental fabric that we were looking at. So I was looking for different waves to be extended, and I was looking at the higher end of the spectrum. My personal sentiment is $2,800 is the target that we hit for the high of this year, will remain that, but I don't think we will enter a multi-year correction as we did at the end of 2011. I think we'll have a much shorter correction in terms of steepness. I think it will be more shallow. So far, we have corrected about 46% of the price move from 2350, let's call it, the beginning of this last impulse phase, waves 1 through 5. We've concluded that we are well into the corrective phase, and I believe that in terms of price decline, while we could see it go below 2,600, I think that at least for now, we'll see at minimum a counter wave up, and from the counter wave up, one last move down, and that will occur in Q1, and then return to a bullish count. And it will be during that bullish count that we take out $2,800 next year. In other words, to simplify it, I think there will be a key difference between what we saw in the middle of 2011, what we're witnessing now, in that once gold hit 1900, that was pretty much etched as the highest point that gold would reach until this period in time, many years later, in which it began to move from roughly the same area when you consider that back in October, as we just talked about, let me compress this. Back in October, when gold was sitting much lower, that would be here at 1957. So when we consider that in the short span of about a year, October to October, we've seen gold move from 1900, the old all-time record high, to 2800, the new all-time record high. And most importantly, I think that we are in a correction. That's obvious, and we've gone down 200, but I don't think the end of the long-term bullish market sentiment has diminished, and witnessing 2,800 is something that we won't ever see again or for many years. I think that we will take that out next year.
Well, Gary, just from a technical perspective, fundamentals aside, at which level, basically the floor for gold, would you think that it's really, really oversold?
Well, I stated this a couple of weeks on another interview, saying that I did not believe gold would go below 2,600. That is where we stand now. It is correlated by not only stochastics on the chart that we're looking at. This stochastic is based on daily charts. We're well oversold. We're below 20 on both the percent D and percent K, well below 20. We haven't seen them cross. However, if we move this to a more delicate cycle, which would be an 8-hour cycle, and let me rescale this for our audience. what you see is that on an 8-hour chart, we've actually gone well below 20 and we have crossed, which is why I am convinced that there's a high probability that we're going to enter a counterwave. I think that at worst we'll see what's called a flat, meaning that the final C wave will go back to 2600. So to answer your question, I think there's a high probability that 2600, maybe 2580 is the absolute floor of this current correction.
When something reaches a floor, does that imply a counter trend or does that imply that more downside is coming usually?
When something hits a floor, realize that technicals are always an expression of fundamental events in the market. Technicals are great for entry and exit levels of a market in play, whether it's trending or what we call range bound or choppy. But the fundamentals are going to define whether any stock or particularly a commodity continues to move higher or breaks and goes into a defined downtrend. I think that as far as gold is concerned, it is still in a long or intermediate uptrend with peaks and valleys. We're witnessing one of those valleys as gold has declined by $200. But on a strictly technical basis, we have to acknowledge that as a market technician, it is fundamentals that are the underlying captain of that ship, let's say. And there's an old saying by Larry Williams, and he said that, technicals are great, and it's kind of like being on a boat and you're sitting at the back of the boat and you're delineating where the boat's headed by looking at the wake of the propellers. But the odd thing about being a technician is only the captain knows when he's going to turn the wheel. Meaning, as fundamental events come out or unfold, they're going to be the deciding factor as to what a market does. And the technicals can get us so far, but they can't get us to the absolute pivot of moving from bearish to bullish, because that is simply based upon the fundamental fabric that has taken gold in this case higher, or any stock or commodity higher or lower.
Can we flip over to a silver chart if you have one ready, Gary?
I probably do. Let's see what we got.
Well, while you're pulling that up, let me just talk a little bit about silver, what silver did. So silver also went down, probably a bit more on a percentage basis than gold because silver has a higher beta. Actually, I'll pull up the exact percentage. So about a week ago, silver was trading at 34.98 cents. Now it's at $30.50. That's a 12.5% decline in the span of a week and a half. So silver's not doing great either. Now, I don't know if the silver market is just following gold or the silver market is projecting lower economic growth and so therefore lower industrial demand under Trump. I'll let you answer that if you can.
We are looking at a daily candlestick chart of silver. So to answer your question, to some degree, it's been moving higher in unison with gold. But there's been a basic disconnect in that gold has traded to multiple new all-time record highs and silver is not broken above 50. However, we have seen a distinct change in, let's call it February, when silver was down around $23. It took silver during one rally to 33. It traded back lower. And this last rally that occurred on Wednesday, October 23rd, took silver to $35. If I'm correct, that is about a 13-year high. We haven't seen silver at this point. However, it never broke above 50, the all-time record high. Right now, short term, I see really strong potential support at about $30.50. This is basis the futures contract. We have, first of all, the 38.2% fib retracement is at $30.46. We have a top that occurred back in the end of August, right there. And we also have a high that came in back in April of this year, this wick that comes in, saying that this is a fairly important technical level. And so I think we could find support. I would say that short term in silver, support is at 36.40 with major resistance at $35 and minor resistance at 32.30.
Let's finish off by talking about what you would do with gold right now. I mean, if you were a trader or even a long-term investor and you're looking at the recent price action, you're probably a little bit scared. If you haven't gotten in, it's reasonable to assume that one might wait for a further pullback to get in. If you've already gotten in, you might think, well, should I sell, take profits now? I'm not asking for financial advice, but just what makes most sense for somebody who has let's say, a 2 to 3 year time horizon?
If you have a 2 to 3 year time horizon and you are working with physical gold, you're buying bullion, you're buying anything but numismatics. I don't want to address that because that doesn't have a price point that is stable across all boundaries, let's say. But if you're buying bullion or gold coins, silver coins, and specifically gold, this is not the time to lighten that accumulation. I think that short term, we've pulled back $200, and this would be a perfect point to accumulate, specifically if you miss the run up from 25 to 2,800, because I think it would go back there, even if it rises as I anticipate back above 2,700 and possibly comes down. In a 2 year horizon, this is an excellent point to accumulate more. And if you have a 3 or 5 year horizon, you simply want to hold, but this is a good point to accumulate if you're anticipating that sometime next year it will break back above 2,800. If you're trading gold, it's a different story. If you're trading gold, once we have solid confirmation that gold has found technical support at 2,600, and by technical, I mean not only stochastics and moving average, but what technicians call a definitive V or a pivot from bearish, which is what we're in short term, to bullish. Then that would be time to enter long positions, looking for a short-term run and the real possibility that there's going to be one more correction before gold begins to move into a full bullish demeanor, I believe, end of the first quarter, second quarter of this year.
Thank you very much, Gary. Appreciate your update, timely update for gold and silver investors. Where can we learn from you and follow your work and study your technical analysis?
We have a YouTube channel, but our premium channel is thegoldforecast.com. And if anyone does sign up for our premium service, if they put David Lynn, and I believe a link will be provided as a code within the ordering page, they'll get 30% off. But the Gold Forecast, YouTube, the Gold Forecast, as well as Twitter.
Thanks very much. We'll put the link down below. Use my sign-up code. Appreciate your time as always, Gary. Speak next time.
Thanks for having me. Yes, next time.
Thank you for watching. Don't forget to like and subscribe.